Before we get going, I do want to talk a little bit about Total Wealth. Quick show of hands, how many people are already members of Total Wealth? Okay. Significant portion of the group. I do want to say if you are not and you are considering it, I think it's an excellent organization. They not only teach about real estate investing, and especially maybe just single family or multifamily, they teach all the different categories. And they also really focus on, your personal life, relationships. So we think it's an excellent organization that you should definitely check out if you have not done it thus far. So tonight we're going to be talking about Lending 101 as our first presentation. We're going to take a break of about 10 minutes in the middle, and then we're going to come back with advanced lending. But it's really going to work well in concert with each other. And we're going to talk a little bit about what Catalyst does first. We try to be a one-stop shop for hard money and permanent financing loans. What that means is with one credit pool and one loan officer, you can get approved for any type of product that you might need in that single-family 1 to 4 and small multifamily space. We've been involved in thousands of transactions over the years, and we try to take that experience and help you avoid some of the mistakes that we've made over time as well. We have a 5-star customer service experience on all social media platforms, including both Facebook and Google. And we offer hard money, which is the money to purchase and repair distressed real estate, conventional loans, which are going to be your best price strategy if we can get you qualified for that. We're very good at taking unique situations, difficult tax returns, and getting you qualified for that best price product. Then we also offer non-conventional loans or debt service coverage ratio loans, which are a very exciting product where you do not have to get qualified on your own income. It's actually a product that allows you to qualify to refinance and be a landlord, and it's based on the property's ability to pay, not your own personal ability to pay. So I was talking with a gentleman in the back who's retired. That's a perfect product for you because you don't have to provide any personal income documentation. We also offer primary refinances, and we're going to go into the presentation a little bit later, but for a lot of people, even though you have lower interest rates, if you want to do more deals, and it's a great time to do deals, you can use your equity in your home and eliminate it being dead equity, as we were talking about earlier, and take advantage of that to get into more deals. And we'll cover the math on it and how it can make sense even if your interest rate is higher. We also offer specialty short-term rental loans. So if you're looking to get into that Airbnb or VRBO space, these are products that do not require your personal income documentation or the ability for the property to pay on its own, because it's often difficult to get that qualified when you're looking at an Airbnb because there's not comparables that show what the rents are, if that makes sense. So we'll go into all those products. And we are going to save questions until the end. And then, as I mentioned, we're going to take a break, and then we'll go into the second presentation, probably about an hour or an hour and 10 minutes from now. All right. So, Ernest, take it away.
All right, so one of the big things to talk about is, number one, educate yourself and network. That is a huge part of being in the investing world. So you attend, like you are now, Total Wealth Academy events, go to case studies, watch videos, and join webinars. The more information you can learn, the more you can learn the lingo of the business. It makes it a smoother process for you going forward. You want to consult with active, successful investors. So when you're networking, I'm always asking people, what are you doing in the business? What kind of investing you're doing? Because I want to understand what you're doing so I can learn from it. Iron sharpens iron, pretty much. So build meaningful relationships. That's going to help you move further in the business. Building relationships with Total Wealth agents. So one thing I ask people, what do you do here pretty much? Are you an agent? I want to be your best friend. That is going to be the person that's going to help you find the properties and stuff. So seek those people out, as well as the mentors, home insurance providers, contractors, lenders. You are building a team. It should be to the point where you're not doing any work on your own. You have a team, and you're kind of calling the shots and manage your team.
That's an excellent point. There are a couple schools of thought on the financing to use, and some people are nervous about hard money. The term hard money sounds a little bit intimidating. In fact, nationally, it's often called private lending, but at the end of the day, it's not hard. It's actually quite easy. It's the easiest loan that you'll probably ever qualify for. One of the things that we do differently as a company is we do want to make sure you have an exit strategy. So whenever you're looking at the hard money loan and you're looking at being a landlord, we're going to make sure that we get you pre-qualified, not only for the hard money loan, which is easy, but also for the long-term loan. We're going to make sure that if you're looking at doing a conventional takeout, that we get you pre-qualified. If you're looking at doing a DSCR loan, that we understand the rents and that you're going to have enough coverage of the debt service. That's what DSCR stands for, debt service coverage ratio. We want to make sure that you qualify for that as well, and that you're able to properly project your returns, cash on cash return, and different returns of that sort. The only way you can do that is if you have a good solid estimate of what your pricing is going to be in that second transaction. But at the end of the day, the reasons to use hard money are a few. One, you get better deals when you purchase a distressed property. If you're buying an owner-occupied type property, one that has no distress, it does not need to close quickly for some reason, there's no repairs that are needed, you're competing against owner-occupants. And as you know, owner-occupants do not need to make a rate of return. They're not looking at cash flow. They're not looking at trying to get equity capture. They are merely looking at buying their dream home. So you want to buy homes that are in a level of distress so that you have an opportunity to get that discount. You're able to avoid loss of leverage and do more deals whenever you do hard money. We've seen a lot of people, we talk with them, they say, you know what, I really want to do this deal for cash. I don't want to pay the fees associated with it. And they buy a property. Maybe it's a $200,000 house. They pay cash for it. They've got about $400K in the bank. They think it's going to be $100,000 in repairs, so they start doing the repairs on their own. Then another fantastic deal comes across their desk. They can't do it, right? Because they've tied up all their money in one transaction. So what we typically encourage people, and I've heard Steve as well say this several times, is that if you have so much money that you can do all your deals for cash, you should just be doing bigger deals. Because true real estate investors use leverage. And the cost of doing business are merely a tool for you to do bigger and more profitable deals. Wholesalers expect hard money or cash. So if you're going to buy a distressed property that comes from a wholesaler or that is presented by Total Wealth, you're not going to be able to present a pre-approval for a conventional loan because you can't use a conventional loan and close quickly enough to buy that distressed property. So they're going to want you to have a hard money pre-approval letter from one of the Total Wealth sponsors or proof of funds. In other words, you're going to show a bank account statement that shows enough money to buy the property in its entirety. So if you're going to be out looking for those off-market deals, you need to have one of those two things. As I mentioned earlier, you're avoiding competing with owner-occupants. And then the quality of the contract is really good. We bought, in another division of a company I have, we bought thousands of homes over the years, and every contract that we submitted was a cash offer, even though we might be using hard money type financing on the backside. The reason that you have to put in a financing contingency is only if you're worried about that transaction not closing and you want what's called an out, a financing contingency. If you're going to honor that contract no matter what with the hard money lender, then you don't have to communicate it as a financed offer. One disclaimer there, you always want to work with your mentors at Total Wealth, and if you are buying from a sophisticated seller like a bank or an REO manager, they may have an issue with you using a hard money lender on the backside of the transaction. But if it's any wholesaler in the market, they're never going to have a problem with that. And even if you're buying on market from an agent but not a sophisticated seller, in almost all instances, that would be fine as well. And then lastly, hard money is just a lot more flexible and far, I'm sorry?
Why would it be different with a sophisticated, why would it be different?
Because there is a deed that is recorded, and they do not want it to be a finance deed. A sophisticated seller is going to want a cash deed, and that's like a bank or an REO. In most instances, that's not going to happen, but you'll talk with your mentor, and they'll be able to guide you through that. Lastly, it's just a lot more flexible and far more likely to close. Whenever you're dealing with a conventional loan, so many things that can come up. You know, you can run into pitfalls. You could have a last-minute VOE check that doesn't go well. There can be a wide variety of things. But the good news is with hard money, almost every time it's going to close, it's just going to be a matter of what the appraisal comes in at. Maybe you're a little bit more out of pocket. You know, you might have a title issue, but then you would be able to get your earnest money back if there's a title issue that precludes you from closing. But at the end of the day, hard money lender's there to close on time and close reliably, and you're able to buy distressed deals whenever you use that type of financing. All right?
So what is hard money? So hard money is a loan to purchase and repair distressed properties. It is going to be a short-term loan The objective is to us provide money for you to buy it and provide funds for you to fix the property up as well. Most hard money deals or most properties that go through hard money would not qualify for a traditional loan because it will have some type of deferred maintenance. So we will provide a tool for you to buy it and fix it up. And then we will include your repair budget in the loan as well. Loan amount is determined by your ARV. ARV is after repair value. So that's what the property is going to be worth once all of the repairs are done to the property pretty much. And so we just give you a quick example. You find a property that's $200,000. That is the ARV, $200,000. We can lend up to $150,000 of that, 75%. So if you were to find a property and the purchase price is $100,000, the rehab is $40,000. You only need $140,000 to purchase the property and fix it up. We can go to $150,000 pretty much. So that is a home run deal. Doesn't happen every day, but it's kind of showing you numbers and math of how you can leverage hard money as opposed to doing it the traditional way. It's a short-term loan. It's 6 to 18 months, so that's why we're really big on the hard money of preparing the exit strategy for you. We want to make sure when you enter that loan, you know exactly how you're getting out of it, whether it be buying, fixing up, and selling, or buying, fixing up, and keep it as a long term. So we're going to have a loan ready to refinance you out of the hard money loan on the backside of the transaction. And then the financing can be used as a cash offer. So if you go and provide an offer, hard money is same as cash. So when the seller sees cash offer, you are likely to get that deal as opposed to someone who has a traditional lending offer, which can take longer to close, more rules and regulations surrounding it. So it makes you a stronger person when you're buying properties. And then quick closings, 7 to 10 days. So you go to somebody and say, I have a cash offer, I can close in 7 to 10 days. That puts you in the front of the line from other people you're competing against.
Yep. Couple things to add to that I think you want to ask your lender about. Number one, what is the term of the transaction? One thing that we do at Catalyst that is a little bit unique is that we have true 18-month loans. Many of our competitors may have a 6-month transaction with an opportunity to extend every 3 months. So that is a little bit of a nuance. We've really gone to bat for our borrowers in times past, like maybe in the great financial crisis back in 2008, 2009. Sometimes lenders or their backers were unwilling or unable to extend at 6, 9, or 12. So we have changed that. We're going with a true 18-month term that gives you a lot more security. You don't have to worry about extending at 6, 9, and 12. So you do want to understand the term of the transaction. Another thing that we have that's unique is we have no LTC requirement. An LTC requirement is a loan-to-cost requirement. That means whenever you are making whenever you're going to close, if you get a great deal, like the one Ernest mentioned earlier, and you are all in on the transaction at $150,000 on a $200,000 property, with Catalyst, you cannot bring any money to close. There are some competitors, especially national competitors, that may have an LTC requirement. So even if you get a fantastic deal, they're going to require you to put 7.5% in on that 75% deal. So you'll only get 67.5% financing. There are some other competitors like us that do not have an LTC requirement, but it's an important factor to know whenever you're going into a transaction. All right? So next, we're going to talk about the different type of lenders that are out there. Some people are only hard money lenders. Some people only provide conventional financing. And whenever you're looking on the portal at Total Wealth or when you're evaluating companies, you want to understand which direction they're in. And you've heard Steve say in the past that the only way you really build wealth is through holding properties long term. You know, flipping properties is a strategy for making money in the immediate term, but it's not a wealth builder. So our objective and the objective of Total Wealth is to help you build wealth in the long term, right? So while you may need flips in the short run to either, if you're going full time, to provide opportunity for immediate income, the end goal is to get to that place where you can hold them long term. So you want to find a lender who either cooperates very well with a long-term lender, or even in some instances, and I think ideally, somebody who can provide both sides of the transaction, both the hard money loan and whatever permanent type of financing you're going to qualify for. And the great thing is, we'll go over this a little bit later, each individual, you might be able to get 10 properties in each of your name on conventional loans, but we also have the products to go into after that, the debt service coverage ratio loans that we'll cover a little bit later on. So also, you want to see what type of model they have. Are you going to work with 2 different loan officers on your permanent financing and your short term? And are you going to be able to use one credit pull to qualify? You've heard Steve talk about this. I'm a big believer. Your FICO score, your credit score is essential if you want to be an investor. So you want to limit the amount of pulls that you have, right? Now, I will say there's an allowance by the government if you're going to work with multiple lenders in a specific category. You often have about a 30-day window. And I know Total Wealth encourages you to maybe work with a few different people, see who you like, see what their programs are like, what their quotes are like. So you can do that, but once you're beyond that time frame is when you can start to have more dings on your score, and you just want to be very, very cautious with that. The difference on pricing, sometimes from a 680 to a 720, and the LTVs you can qualify for are tremendous. And then another thing is, are they lending their own money or are they a broker? You know, at Catalyst, we put all the loans on our own balance sheet, so we get to make the decisions. Some other people might be brokering that loan, and it's a different process, both from an underwriting and a speed perspective. And then lastly, and I think maybe the most important thing, is that group also a group of real estate investors? Because that's how they can be a trusted advisor. They can give you advice, they can give you direction, and they can make an impact in your success rate and how often you increase your returns and avoid those critical mistakes.
I'll piggyback too. The single point of contact model is huge. If you think, I mean, most of you guys, I would imagine, have bought a house before. That is a big process of buying a house. So being able to deal with one person on both sides of that transaction takes away a bunch of headaches. They want credit pull. They understand what you're doing on the rehab, and they understand what your end goal is. So, and then you get to repeat and come back to that same person over and over again. So that relationship building is what we're really about. But the single point of contact is a game changer if you're in the investing world. So hard money, rates and fees. So typical interest rates range anywhere from 9.99 to 14%. The way we decide how you fall in that rate sheet, we have a risk-based model we use. So a couple different options. We look at credit, utilization, capital, and that will determine where you fall in on that rate sheet. Points usually range from 2 to 4%. Same thing with the risk-based pricing model. We'll determine how you fall on that. Lender fees vary. Numerous versus, so the lender fees, so we have one fee pretty much in regards to fees, whereas other people you'll see have a bunch of junk fees spread out across your HUD and whatnot. So one fee, you know what you're getting into. There's no searching for other fees. Appraisal fees. So our appraisal, we have a very special project nobody else has. We're really proud about it. It's called the Bridge Appraisal. In a nutshell, what it is, if you're going the conventional route, if you're doing the buy and hold strategy, we have an appraisal panel set up to where the same appraiser who does your hard money appraisal will be the same person who does on the backside for conventional. So what that does, it mitigates the risk of a lower appraisal coming down the backside. So going into a transaction knowing what my front appraisal and back appraisal is a game changer as well, because at times it happens, appraiser is a professional opinion. So you can get an appraisal on the front side of hard money, those are non-regulated. You get to the conventional side, those we can't have as much communication with the appraiser. So there can be a difference that comes in there. If there's a difference, then you pay the difference that comes in lower. So that bridge appraisal mitigates that risk for you, and you go into it. It takes away some of the gamble. I would say that pretty much. So it's a great option. And then the cost you're paying for it is less than what you pay for 2 appraisals with anybody else.
Yeah, that's a great point, Ernest. And that time frame, that window of opportunity is 120 days. We don't have to rerun, the appraiser does not have to rerun comps or come up with a new value in that first 120-day period. And as I'm aware of it, there's no one else in the country that has this exact product. So we're very excited about it. And it can really help you feel a lot more comfortable, because the big name of the game is dry powder, right? How much dry powder do you have to do deals? And if we can limit the out-of-pocket at each transaction by having a little bit more safety and security on that backside appraisal, that can mean the difference in you doing 9 deals and doing 10 deals, right? With however much money you may have. Appraisal differences, I want to talk about this. So if you're buying a traditional property, that appraisal is going to be an as-is condition, right? So the appraiser goes out, looks at the property, and he's going to compare to 3 other properties that are as like as possible, similar in every possible way: size, square footage, lot size, bedroom bath count, location, a lot of different factors. And then they'll make slight adjustments on that and come up with an ending value, right? The difference whenever you're dealing with a hard money or an investment loan is that it's going to be an evaluation subject to repairs. So you have to provide a repair budget, and you can work with your your total wealth mentor, to come up with that. You come up with that repair budget, and then the appraiser is going to say, this is what the property would be worth if these repairs were made. So it's a prediction of value based on your repair budget. I do want to emphasize two things. Most of these off-market deals have to close quickly, right? Sometimes it's 7 days, sometimes it's 5 days, sometimes it's 2 days. And you are a big part of the process. You must get your repair budget and the contract in right away, because we nor any other lender, can order an appraisal without having those two critical things. So what we really encourage people to do is make sure you get fully pre-approved with your lender, whomever that is. It's us or somebody else. There's a two-step process typically. One is you get pre-approved based on your application. Step two is you send in all your documents and get that final pre-approval. The worst thing you can do is find a property and be trying to get pre-approved at the same time. Find tax returns, find bank statements. It's just way too much. You have to be singularly focused on getting the repair budget and the contract in so that appraisal can be ordered, and then you can make sure that we close on time. Because if you want a wholesaler or a total wealth agent to continue to bring you deals, you cannot be a part of the problem that causes deals not to close on time. Because you never know what's happening with that wholesale deal. It could be facing foreclosure. It could be that person has to move, right? There could be a wide variety of things that are taking place, and we must make close dates, and you want to be a part of that solution so people want to bring you these off-market deals so that you can achieve your goals in real estate. A couple other things here. The long-term appraisal is regulated, as Ernest alluded to earlier, which means that there can be no communication between salespeople and the appraiser. With hard money lenders, it's not regulated, so there sometimes is interaction, and that might impact values, right? On our transactions where it's a bridge appraisal, we do not reach out to the appraiser whatsoever. It's an AIR compliant, which is a regulatory group. I won't get into that too much, but at the end of the day, our appraisals are ordered the same really on both sides. But the reason that second one might come in lower is if it's a different process, less appraiser interaction. And so you always want to be aware of that possibility if you're not using a bridge appraisal type product. Doesn't happen all the time, but in a market like we're in now, where property values are actually coming down a little bit in most of the Texas major metros, it's more of an opportunity than it might be in other times.
I'll say too, having that panel is very important, because our appraisers are used to seeing these distressed properties. They're used to going to these properties and they're smelling. And it doesn't bother them when they are looking at your rehab budget. They're looking long-term, what's going to be when you finish. If you get an appraiser who's used to looking at 600,000 plus homes that look amazing, and he walked into this distressed property, his natural response is going to be like, this is not a good property, he's going to have a bad value. So with having that panel of guys who are used to seeing on a daily basis, it doesn't bother them. And they are looking at your scope of work, your rehab budget, to see what you're going to do, and they base their opinion off of that. And that's a huge difference.
Yeah, and to add to that, we've communicated with our appraisers that our expectation is to compare to the top of the market, and that we will hold the borrower to the standard of getting completed to that level, so they're not uncomfortable with using comparables that are in the top end of the market. So that can really drive up your appraisal and get the highest ethical value, right? We're not pushing them to do anything unethical. It's an ethical appraisal, but you do want them to feel comfortable comparing to the top of the market in that particular subdivision or neighborhood.
All right, so hard money versus conventional. So your best deals are going to be the ones that are in distress. So we all talk about this. When you walk into a property and it smells horrible and it looks crazy, that is dollar signs. Like that is, as you start thinking, like, I'm about to make some money off this deal. You want that, because it's not the most sought out property. People are not competing for it. They're not overpaying the price for it. So you see distress, dollar signs should be going off in your head pretty much. So the way you find those deals usually come with a death in the family. So they mean the family needs to get rid of their property pretty quick. You typically find those type of deals that come up on those. Foreclosure, taxes, HOA, same thing, typically come up for hard money deals. And then expensive repairs. So properties you want to get, there's a repair budget. If you go the standard conventional route, you typically pay the 20-25% down payment, and then you're responsible for the repairs out of pocket. So, and then unexpected expenses like job loss, people can't afford the property no more and have to get rid of it really quick. You can come in and be the hero as a borrower on the backside and say, hey, I can get this property off you in 7 to 10 days and be a cash offer. That you're basically saving their day for them pretty much. So property condition does not qualify for conventional. Like I say, no deferred maintenance. It has to pass a conventional inspection in order for them to do the loan. So loans that fall in this category typically have some issues. You need to repair it. That's where hard money can come in and assist you on that. And then some big major things, so roof, foundation, HVAC, and plumbing are the major things you're going to see that will not pass a conventional inspection.
And you should not be afraid of making those repairs. In order to get the discount that you want, you're often going to have to make those significant repairs. The more significant, usually the bigger discount you can get. And foundation is so common in Houston. Like the home has been around for 15, 20, 30 years. It's just almost always going to be a part of the equation. The others, roof, I mean, that's a very common repair. Most of you have probably repaired a roof, should not definitely be afraid of that. Plumbing, you know, you can have that plumbing professionally checked. If there are major repairs that need to be made, you just need to bake it into your numbers. That's all you really have to do. The thing you want to make sure of is that your offer is relative to the budget size. And then if you're getting that equity capture and you're getting the cash flow, those numbers for repairs should not be intimidating to you. So we're going to give an example of, and hopefully you guys can see the screens well, of buying a home on a straight conventional loan and how it changes the out-of-pocket. So we're going to look at a straight conventional loan versus a hard money transaction and show the differences in how much dry powder you have to put into the deal. So this particular deal, you can see $136,000 purchase price, an estimated repair budget of $19,200, total needed for repair and purchase $155,205, estimated loan amount $102,000. That's a 75% LTV product, pretty common on a non-owner-occupied loan. So you got a 25% down payment of $34,000. You got that repair budget you got to do out of your own pocket because a conventional lender is not going to give that to you. Then you have closing costs and repair. So to acquire this relatively small property, in all honesty, you're going to be $57,000 out of pocket, okay? Now, you don't have as much in fees as you're going to have on the other transaction, but dry powder is an essential part of you getting into as many deals as possible, right? So this next slide, we have a little joke there. Jeff threw that in there. But the rates have gone up a lot lately. You know, the rates have gone up a lot lately. We used to do 6.99. Now they're 9.99. We used to lend out at a significantly lower number on hard money than we're actually borrowing from the banks today. We're a conduit for money. But at the end of the day, here's the example for a hard money transaction, right? After a repair value of $187,000, looking at doing a 75% loan, so the purchase price, all the same numbers here. The initial LTV is 83%. So you're going to have 2 points on the transaction, an interest rate of 9.99, and then you come and look at the closing costs associated with the transaction. You know, you got origination fees, some other fees associated with it. We think these fees are relatively common across the industry. And then you have refi closing costs on the backside. So this is baking in the front side transaction and the backside transaction. The out-of-pocket is $24,810, right? So 57 versus 24.
2 properties.
So if you think about it, if you could buy twice as many properties at the end of the rainbow whenever they're paid off and the renter has paid off the mortgage that you got, you have 2 properties at the end of the rainbow. Let's say they're worth $350 at the end of the rainbow. You could have one worth $350, or you could have 2 worth $700, and all the cash flow associated with that. So it's a great vehicle to have less out of pocket and do more deals.
So benefits of working with a hard money lender, you get help through the rehab process. We have an in-house project manager. He's going to look at every single rehab that comes across that we do a loan on. And so he will look at it. He's just a second pair of eyes to assist you. So if you have a rehab budget and the GC is charging you way more for a roof, he will point out, hey, this roof looks a little bit high. You should go back and talk to your GC. Or if the GC tells you everything looks good, we have an inspection on it, he's going to say, hey, the AC is not in working condition. You go back and include that in your budget. We are there to support you guys and help you out. As a lender, too, we're doing a loan. We'll make sure that the property is covered. So it's a hand-in-hand relationship. So you have the second pair of eyes on the project. So the expertise, evaluation, and deals. So you have us as a lender who's going to help you out, but you also have Total Wealth, your mentor, whoever is helping you. You're going to have enough support. Once again, we talk about building that team. That team is so important. You are not going to be out there lifting up hammers. You're not going to be doing any type of hard work. You're just managing a deal, and you're managing your team. That is so important. And assistance with title and other issues. So talk about all the time. We are professionals. We do this on a daily basis. We have title companies involved. So if you go buy a property with cash and you have all kind of title issues, you don't have a title company, that can put you in a bad spot. So when going to a lender, title is involved, you know you're getting a property that's free and clear, or no title issues on it, no other liens on there, and you can go into the transaction knowing that you own the property right out and not have any things on the backside of it. And then you use the lender to help hold contractors accountable. So we're really big on this. So when you buy the property, we'll give you money up front to buy it, and then we also keep funds set back like on a draw schedule, and we reimburse that to you as you complete different portions of the project. If we go out and so it's pretty easy. You have your phone or iPad, you walk on the property, and you say the kitchen is done, you click kitchen. If you say flooring is done, you click flooring or roof. Once you click it, we come out there in 3 to 5 days to inspect it and have funds deposited back into your account. If we notice something is not done right, we're going to take pictures, give a detail of it, and give that back to you so you can report it back to your GC, and you can make us the bad guy. We're okay with you saying my lender is holding back funds because this wasn't completed correctly. We're okay with being a bad guy for you guys. And then that makes them say, okay, well, you're really checking. Let me do a better job up front for you. So that's the benefit of having a hard money company with experience to back you up pretty much in your transactions.
Yeah, and one of the bigger dangers in real estate investing, and it's everything that's worthwhile has dangers, is that you pay a contractor significantly more than the work that they have done. Because oftentimes they don't have a extremely high amount of capital on hand, so they can sometimes get to a spot where at the end of the rainbow, you don't have any more money for them, and they don't have enough money to do the job. So you want to make sure that you really closely mirror the process. And in hard money, and this is the way you should operate it, even if you do deals for cash, you should give them money to kick off the job, but then after that, you're reimbursing them for work completed. One important thing is that contractors want to pay their people every Friday. So they'd love for you to pay them every Friday. You could say, I'm happy to pay you every Friday, but I can only pay you for work completed. I can't pay you just because the week has taken place, right? You have to make sure that you're making tangible and real changes to the property so that I can pay you out for those things that are completed. I mentioned this earlier, but getting fully pre-qualified is a huge thing. Wholesalers will not consider offers from buyers that are not pre-qualified. The difference between pre-qualified and fully pre-approved is, like we talked about earlier, one's just based on what you state. The other one is based on what you document. And you want to be in that second category where it's documented. And that's not unlike the traditional lending world where a fully pre-approved contract is far more valuable. We want to be able to provide that same safety and security to you and to the wholesaler as well. Another thing to keep in mind is how many transactions are you going to be able to close with your hard money lender? Because a lot of people come into the Total Wealth Academy and rightfully they get very enthused. They see the numbers that can happen and they want to make a financial impact and they want to make it quickly. But you want to be in close communication with your loan officer for a few different reasons. One, you want to be aware of how much out of pocket you're going to be on each of these transactions because you're going to have to bring enough to close those deals. Secondarily, whenever you're looking at the backside refis, you also, if you're doing a buy and hold deal, you want to understand the implications of those closing at the same time. Because whenever you're looking at, let's say you have 3 properties, in order to get credit for the rents on a refinance on a conventional loan, you have to close all those transactions on the same day. Now, you may be more affluent, have a very high level of income, and you might be able to qualify for a conventional takeout just based on your own personal income. But I would say the average person cannot do that, and they need the rents to offset the payments. The good news about all this is if you can qualify to buy your home and you have a property that cash flows appropriately, just about everybody is going to be able to add 10 properties in your name and 10 properties in your spouse's name because you're able to get credit on each of those properties as you go along. The only thing that changes over time is you have to have a little bit more in reserves, but it's a very small amount. The reserves are not normally what hurts people. It's really not. What normally hurts people, we'll talk about this later, is whenever you write off too much instead of depreciating it whenever you come back in to get qualified in future years. But we'll deep dive that in a minute. But you do want to be in constant contact with your loan officer, whether it's Catalyst or one of the other great groups that sponsor them, and making sure both up front and on the backside you have a strategy with how many deals you're doing at one time. We don't want to preclude you from doing it. We love the people that are fired up and do a bunch, and we see the benefits of that, but you just want to be careful and be in communication.
I'll add some to that. So, and then when people are new investors, they get excited. Like you come in, I've had many borrowers who brand new to it and come in and do 3, 4 at a time. Like they get excited, they see the difference it makes in their life. But if you're doing and you operate in that kind of speed, you want to be communicating with your LO. Once you're in our system, you're pre-approved. For us, it's simple as plugging numbers in for you. We can tell you exactly how many deals you can do, how many you can manage at one time. So you definitely want to stay with the same lender because they can have your profile in front of you and they can direct you. Okay, you can do 3. You start doing 4, we got to kind of scale back or just take our time a little bit. But you don't want to be split up amongst separate lenders with deals everywhere because nobody knows what's going on and they could put you in a bad spot. So stick with a lender who can see you all the way through the process and they can guide you through that process.
For sure.
Want to do this one?
Oh, yeah. So I'll cover this one just for a few reasons. But at the end of the day, right now, I do want to cover a couple of reasons. Like I hear a lot that people say, I'm waiting on the market to come down before I start buying. Has anybody thought that? Nobody? That's good. That's a smart thought because we really don't see in the state of Texas property values coming down that much. I mean, it's been relatively stable thus far. The reason for that is the net migration into the state is very high. Texas has normally been a very stable market. It doesn't go up a tremendous amount other than Austin. That's kind of an exception to the normal Texas rule. But your major metros, Dallas, San Antonio, and Houston in particular, and even areas like Beaumont or Corpus Christi have been relatively steady. So we don't see huge drops in value. But if you think about it, what is a better scenario is to get more of a discount to the current value, and that's what we're seeing today. What we're seeing today is that before rates increased, the average discount on a property was about 10% on properties below 350. That's in our entire portfolio that we lended on. And now, after the rate increases, we're seeing that discount be about 27.5%. It's a significant difference. The average out of pocket before rates went up was probably $45K, and now it's like 22.5. That's a big difference, right? And this matches up with auction.com data that we saw 2 months ago, where the pre-rate increase discounts was about 9%, and now it's about 29%. And that's on national data as well. So this is, we have a relatively small data size compared to national data, obviously, but it matches up on both sides. Another thing that you always want to focus on is your cash-on-cash returns, right? So if you think about cash-on-cash returns, it's the amount of money that you put into a deal versus the annual cash flow. On those deals where people were out of pocket about $45K, they were getting about $450 a month in cash flow. Cash flow was definitely higher. And that cash-on-cash return was about 12%. The cash-on-cash return today is also about 12%. The numbers are different. $22,500, $200 in cash flow a month, $2,400 annual, but still 12%. But here's the thing. Would you rather have 2 properties or 1 property and get the same cash flow and have the same out of pocket? I think it's way better to have 2 for countless reasons. Diversification. Rarely are both properties going to be unleased or you're going to have vacancy on both. And at the end of the rainbow, like we mentioned earlier, you have 2 properties worth $700K instead of 1 worth $350K or whatever your numbers are. It's basically going to be double. So because of that, it is definitely an excellent time to buy.
I'll add something to that too. So what we noticed when the rates were lower, the market was a whole lot more competitive. People were paying over and beyond asking price for properties. So you would see it the deals were crazy. I was buying a house in that time frame and we were losing out on transactions because I had a cap. I knew I couldn't afford any more than this.
Right.
But it was how competitive it was, and you can see that in the investing world too. Whereas now that rates have increased, people are me get out of the game for a little bit, let me kind of rest and see what happens. But it's not as competitive. So now you can get really good discounted properties and come to closing with we're seeing deals where people are paying close to nothing out of pocket, or even like below 10-some thousand. Now we know rates going to change eventually. So if I can get a house I really love, we buy the house now with minimum cash out of pocket, keep some of my capital, and when the rates change, I refinance, and I still have that property. So it's not as competitive, and so the savvy investors now are taking advantage of that and buying as many properties as they can in this time frame.
Yep. And to Ernest's point, if you think about it, if you bought that property and you got that super low rate, which makes people feel really good. Like, makes me feel good. I got a 4% rate. That feels really good. But there's nowhere to improve your transaction from there. It's not going to get lower than 4. So you're kind of locked in on that cash flow. Think about it. Today's rates are higher. They eventually will go down. So you can take that cash flow, which is still about a 12% on average cash-on-cash return, but it will go up exponentially if rates come down to 5.5 or 5. Me and a lot of other people doubt it ever gets back to 4 again on a non-owner occupied deal. That's maybe not probable. But even taking it down to 5 or 5.5 will make a significant difference in that cash flow. So this is just an example of a 90% example. $300,000 property, you can see up top, 75% transaction. I'm not going to go every number, but back then on this same property, you might be $55K out of pocket, right? Pretty big number. Next is the 72.5% example. And I will admit we're not seeing this in the major metros as much. We lend outside of the area. So if you're willing to go a little further out of Beaumont, Magnolia, you can see these numbers. If you're inside the loop, it's going to be closer to 77.5, which might mean this number's closer to what I was talking about earlier, maybe like a 22.5 out of pocket, right? But the reality is the deals, even in the major metros, are significantly better. This is a little bit of an extreme example, but because you're going outside the major metros, but if you're in the major metros, still significantly better deals. The 90% example, total equity capture, that's another big one. You're out of pocket back then, you're out of pocket maybe $55K, and you're getting equity capture of 14.7. Conversely, today, you might be getting equity capture of up to 62 in the more rural areas. In the major metros, it might be 40 or 50. But, and then the cool thing is you have that opportunity to refinance at a later date. 4.25, I think that's a little aggressive. But, if it's not 4.25, that cash flow might not be 754, but it could easily be 600 or 500 based on a 5.5% rate or something of that sort. I think we covered the majority of that. We'll move on to this next slide.
So work with lenders and other vendors on TWA. So Total Wealth, they are going to vet out vendors for you. They're doing most of the hard part for you. So when you're looking to build your team, go to the vendor list. They went through them. They've saying who are good, who's not good. So use your resources you have in front of you. You're only as good as your team. We already talked about that. They're going to support you. They're going to help you. You're just managing the team. That is your only job, pretty much. You're thoroughly evaluated by Total Wealth Academy. The vendors understand and support the Total Wealth model. So for us, when you come and talk to us, we understand what Total Wealth is teaching. We come to a lot of the case studies events. We can repeat the same thing and help you reach your same goals that you talk to with your Total Wealth mentor. So that is very important to have someone help you line up with the goals you have and all kind of speak in the same language. So that's really big. And Total Wealth can exert their influence. So if something happens with a Total Wealth vendor, they can definitely chime in and help rectify any issues that may pop up. So it is good to stay within that vendor list because you go off on your own, something happens, there's nobody there to defend you or back you up pretty much. So use the vendors that Total Wealth have vetted for you.
Yeah. A couple examples of that. We've seen some people maybe use contractors that are not on the TWA list. They might be more reasonably priced, but they're not vetted. They don't have the reputational risk of losing a stream of business like comes through Total Wealth. So we really, really encourage that. And in the lending space, you don't have to work with us. There are several great lenders here, and I think you should check into many of them. But what I will say is the people that work with Total Wealth makes sure they understand the investing business. So many people that do conventional loans have no clue how to work in this particular space. And they also don't have the appraisal panels that make sure, as Ernest mentioned earlier, that you're working with appraisers who are not going to lowball your value because they walked in and they saw, some cat poop in the corner or whatever it may be. Like there can be some things that really intimidate newer appraisers that just does not happen if they're experienced. Make a decision on value, not price. That's kind of what we were talking about earlier. You want to be looking at what your overall return on investment is. Looking for top quality people, products and services, and then a strong recommendation from TWA, but also going and looking for these different providers on Google, Facebook, understand their value proposition, and make sure that they are aligned with what your goals are.
All right, So key difference in private money lenders and hard money lenders. We kind of touched on a little bit, but I'll go again. So private money lenders, they're usually limited on what they can do. So most private money are just going to say, hey, here's a lump sum of money, go invest with it, wish you the best of luck. Whereas with a hard money company, we're going to go over and beyond. We're going to have appraisers go out there. We're going to have title companies involved. We're going to evaluate the property for you. We're going to review your budget. Like we go over and beyond to protect our asset, the property we're lending on, and also protect you as a lender because it means a borrower because the goal for us is to rinse and repeat. You go do a deal, it goes great, you come back and do it again. That's what we're all about. We don't want to do one deal and never see you again. It doesn't benefit us as a company. And we've had really savvy borrowers, like really savvy, done multiple deals who decide, all right, I got it, go do it on their own and do like some cash deals, and they don't get an appraisal and don't realize that the property is not
Zoned properly.
Zoned properly. So they buy the property with cash, thinking it's a single family, or thinking single family is really zoned as commercial property. So now you have a property that now they can't even sell because they didn't go do the right due diligence up front for it. So be careful with private money is good, they give you good rates like that, but just make sure in that process you're doing due diligence and you have a asset that you can sell or move out of later on.
Yeah, one of Ernest's most experienced borrowers, I think maybe did 50 transactions a year. He had 3, I think, that he actually used a private money lender. He didn't do all those for cash, but they did not get appraisals. And you may not be aware of this, but the appraiser is the only third party responsible in a transaction for ensuring that a property is properly zoned. So if a property is zoned industrial, as one property that we had to end up taking over from a borrower, it could be cataclysmic. For example, we took over that property. We fortunately were able to make the person whole. It's not like we foreclosed on them. But we had a property for $150,000 appraisal. Because it's improperly zoned, the best offer we've received from the city is $15,000. Right? So in many ways, an appraisal is like insurance. And I'm assuming everybody in the room gets insurance. Is it free? No. But it provides you protection from things that can make a huge difference. So that, that zoning thing can come up quite a bit. So I think having an appraisal is always important. And then the
That's part. So the same thing with private money guys. At times they're out of money. So you may come up on some really good deals you want to go and get, but that private money may have too much money already out in the streets pretty much. And they don't have the capital to give you at that point, and you miss out on a really good deal. So for us, as a lender, we have different lines of capital set up. We are not going to run out of money. We're always going to be able to lend to you. So that's another option to keep in mind as well. And then they're difficult to vet. Like a private money lender, you can't go and really do reviews on them or go look at the previous customer reviews. So it's hard to vet them. So you got to trust them at their word. Whereas us, we are really proud of this. I'm a big fan of reviews. Anything I buy on Amazon, I read the reviews for about 20, 30 minutes and like really shift through them. I'm big on that. So if you go look on reviews on us, it's an average of 5-star across the board on all our platforms. And we're really proud of that because that means our customers are having great experiences and they wanted to share with everybody else. So the reviews are huge.
Yep. And I don't want to disparage private money lenders because there are some really good ones. I think you just have to have a good way to vet them because it's not as easy to vet, right? Get strong referrals from other people because to his point, sometimes they can't close the transaction. And then even worse case, we've heard sometimes that they close the transaction, but they cannot fund the repairs. So that's an even worse scenario because you're already into it and then you're expecting to get $100,000 to do repairs and then they unfortunately run out of money whenever you're in the middle of the project, which is really a nightmare scenario. So if you're going to use them, make sure you get them thoroughly referred from other people because they're probably not going to have a Better Business review or Google reviews or Facebook reviews. So just be thorough. Why you shouldn't use a national mortgage company or bank is a really big deal. Many of them do not understand non-owner-occupied transactions at all. They might cap you at 4 or 6 Fannie-Freddie transactions. Most LOs have never done an investment property, so they just can't really guide you through that process. The appraisal panels are not experienced. It's often a longer closing process, and then you might have last-minute issues whenever they figure things out. So once again, I'm not saying you have to use Catalyst, but definitely use somebody that is a real estate investor-focused group and that is vetted by Total Wealth.
So permanent financing options. So conventional, we already talked about DSCR and stuff. So conventional is your standard Fannie Freddie loan that's backed by the government. They're going to give you the best rates. There's typically no origination points associated with those loans. They do require more documentation. So if you are self-employed, we're going to need tax returns. If you're a W-2, we're going to need W-2 and pay stubs. They typically keep you at 75% loan to value. You have to put those loans in your personal name, whereas the other loans you can go into LLC. You can go up to 85%. There's pros and cons going up to that. We wouldn't suggest it, but you do have that option pretty much. Delayed financing, if you bought a property with cash, you cannot refinance and get out the full amount up to 75%. Like you have to wait 12 months to do that. So that's a big thing to look out for as well. And it's direct, so there's like, for our conventional, there's no overlays. So we provide the rules or guidelines that Fannie and Freddie directly provide pretty much, nothing else on top of that. And one good thing we do with those is you can get a clear to close before the project is actually completed. So our ultimate goal is for while you're rehabbing it, to already have that loan processed and be waiting for you to say, hey, the property's done. And we're saying, okay, this is our final inspection and close within days or weeks after that. But it saves you time in that hard money loan, saves you paying additional payments in it as well.
Yep, and to Ernest's point, just to clarify one thing, a lot of our refis on conventional, we do it 75%. You can go up to 80%, rates are a little bit higher, but you can do that without paying PMI. Once you go to 85%, you pay PMI, and that's something that typically is not a good financial decision. You want to stay really at 80 max. You just need to evaluate the delta between your interest rate and your payments from going from 75 to 80. Non-conventional programs, I want to deep dive this a little bit. Basically, there are a wide variety, but most real estate investors are going to fall into this no income doc program. So with a conventional loan, we are evaluating your personal ability to pay. With a DSCR loan or a no income doc loan, we're evaluating the property's ability to pay the mortgage payments. So debt service coverage ratio loan, that means, for example, if a property has $1,500 in PITIA, that's principal, interest, taxes, insurance, and homeowners association dues, that's $1,500. A good rule of thumb is most DSCR lenders are going to want like a 1.1 DSCR, right? So if that's $1,500, they're going to want to see at least rents of $1,650 in order to cover that. That's what a debt service ratio. So whether you're self-employed, whether you are retired, whether you don't have documentable income, none of that matters. You don't have to provide those things. And these DSCR loans could be a good solution. What's interesting right now is the government has put a lot of loan level price adjustments on the conventional loans. So they're a little bit more costly than they were in the past. And the gap between the prices on DSCR loans and conventional loans is as small as it's ever been. So you can really, you're not going to pay that much of a premium on these DSCR loans, and you can really get good cash flowing deals. Ernest mentioned this earlier, you can borrow on some unique structures like an LLC or a trust. And then the other thing that I would say is, if you're making the decision on, do I want to borrow in an LLC or not? There are definitely protections with borrowing in an LLC. There are less protections if you're borrowing in your own name, but you can purchase umbrella policies and other things like that. You can talk with your mentors at Total Wealth, but at the end of the day, unless you have significant assets outside of what you're looking at putting into these properties, it could be a really good idea to use those conventional loans to purchase an insurance property that can stop them from attacking your other assets. And I've heard Steve say this many times, the best thing you can do is be a good landlord. Treat people right, repair your property properly, and you're probably not going to have a lawsuit. Knock on wood, I've been owning properties for 10 years now. We have a decent sized portfolio. I haven't had a lawsuit, but if somebody comes with a problem, we try to handle it, treat them fairly, and more often you can avoid those things. I'm not saying that you don't consider it, consult with your attorney, but it can be really good to get those better terms if you qualify for them.
All right, so this is talking about a hard money process and submitting your deal. So the big thing is appraisal. It will be, we're talking about subject to versus as-is appraisal. It'll be a subject to appraisal. We're looking at the after repair value for it. We also will get a survey if it's needed. Title will let us know if we need a survey or not on the property. And then always title. Title's going to get title insurance for you. Any issues that can delay closing. And usually only way to get your deposit back is the wholesaler returns it. So if you have a title issue, then the earnest money can be given back to you. It's on the only way you can earn money back pretty much.
If you're going to do a conventional refi, if you're flipping, the survey is only required if there's an outbuilding or there's an addition that we need to make sure of, or the property is meets and bounds. And meets and bounds are like rural properties, lot and block, or more urban areas that are more developed, like developments. But at the end of the day, if you're going to do a conventional refi, that does require a survey. So in many instances, we'll go ahead and get it for you on the first transaction. We don't want to miss a close date, but we do like to get that up front so you're going to need it on the backside and you know exactly what the survey is going to look like. A couple other things here, that rehab budget or scope of work, I mentioned it earlier, you got to have that right away in order to get the appraisal ordered. It is the basis for the appraised value. I want to emphasize that. The more detail you can provide, like granite countertops, stainless steel appliances, if you're doing a flip, definitely talking about, I'm going to use a Wolf range, I'm going to use a Sub-Zero refrigerator, I'm going to use quartz. If you're doing a high-end flip, giving that detail so the appraiser is very comfortable comparing to the top of the market is essential. If you give a very basic repair budget and they have no idea what you're doing, they are required to take a more conservative approach. Because if you just say countertops, they have to assume it's the lowest end. If you state specifics, they can go towards the top. So that's a big part of you getting the best possible value on your appraisal. And then if the appraisal comes in lower, what happens, right? There is an appeal process, but it takes time. So that's why we want to move everything forward as quickly as possible, getting pre-approved, getting your scope of work and repair budget in so we can get that appraisal in early. And then we can, if we have to appeal the appraisal, we potentially can. The one thing is you can't change the overall spirit of the repair budget after you submit it because the appraisal is based on that, right? What you can do is provide more detail after you submit your initial initial repair budget to get the appraisal process going so that you can have more detail and get smaller draws. We and most lenders are going to pay out draws based on your budget. So you don't really want to say kitchen for 10 grand because then, we don't want to get into the debate. Is it 50% done? Is it 60% done? You just want to break it out. Appliances, countertops, cabinets. And then you can get paid at each step along the way so you don't get tight on cash.
All right, so the conventional loan process, so we do credit reports. We're going to pull a hard pull. That credit report is good for 4 months, 120 days from the date it was pulled. Get your rehab done as soon as possible because we don't want to have to re-pull that credit report again. Our goal is to have minimal credit pulls on your report pretty much. So within that 120-day, 4-month period, try to be proactive in getting that rehab done. We'll be checking in with you on a weekly basis, just trying to get updates and make sure it's moving along. Things that can affect your refinance, making large purchases. I've had customers who get a loan, then they go out and buy a boat or buy some jet skis, something of that nature. That is a new liability we did not account for originally, and now we have to account for that, and that could have an impact on your debt-to-income ratio. So we'll tell you this up front, but just avoid large purchases. Don't try to buy any new cars in that time frame. Anything major that can impact your debt-to-income ratio. Don't change jobs. Changing jobs, again, affects your work. You usually got to have a 2-year work history. If you do change jobs in the same industry, we can work around that, but don't do any major changes. Don't go from like a W-2 employee to self-employed. That changes everything for you. So we'll, again, give you a heads up on it. No new credit inquiries. If you go get a new credit inquiry, the underwriter's going to ask that you go inquire and get a new loan, a new liability. We have to ask about that. You have to write a letter of explanation telling what you did it for. No late payments. Late payments on your credit report can have a huge impact to your score. They can drop it down and put you in a position where you don't qualify any longer. And then reducing bank balances. You do need to have reserves set up. So if you go and spend all the money, then you don't have a reserve. That can cause a problem underwriting as well. If you ever got any question, when in doubt, call your LO. Call your LO and we'll advise you to another way.
And I do want to emphasize that additional properties under contract. A lot of people don't understand this. It is not only properties you own that must be included in your debt-to-income ratio. It is any property under which you have a contract to buy it, okay? So that's a really big difference because if you are under contract and we have to bake that number in, it could totally change your numbers. And you are going to be required to sign a document at closing that says you are not under contract to buy any other real estate? And you want to answer that honestly. So you just want to make sure you're always in contact with your loan officer. We're not wanting to discourage you buying multiple properties at a time. In fact, we encourage it. We think that can be very good. It's a good time to buy, and you want to be doing it actively, but you have to make sure that your loan officer knows that information so we can bake it in, and whenever you go to sign that document, you can say there are no other properties that I own or that I am committed to buying. All right? Long-term financing strategy, what you'll often hear from mentors like Total Wealth is that we'll often hold the property 5 years, and then you're going to come back and either refinance or sell those properties so you can extract that debt equity and put it into newer and bigger deals, right? So you want to have that long-term strategy in mind when you're doing this. Am I going to refi or I'm going to sell? In my opinion, it's hard to get those properties. I have personally not sold any of mine. I like to refinance them. As you probably know, or if you don't, it's a very good thing. Whenever you refinance, you don't have to pay taxes on any of that, right? You might get $100,000 per property whenever you go and refi. There's no taxes on getting money from a refi. So it's a great tool, and you're able to continue to invest in more properties. Keep in mind prepayment penalties. Some of the DSCR loans do have prepayment penalties. They're normally a 5, 4, 3, 2, 1, which means in year 5 it's only a 1%. In year 1 it's a 5% prepayment penalty. I do want to say we have one great product we're very excited about that you can buy the DSCR prepayment penalty down to 1 year with only a quarter point. I'm not aware of any other option out there like that at the moment. So if you're looking at doing DSCR loans, definitely talk with us because that's a great option. You want to understand the max number of conventional loans you're going to do and then what you're going to transition to after that. And then, also we have products that are called blanket or portfolio loans. So if at the moment you have a lot of properties, you would like to extract cash from them to do more deals because it's a good time to buy, we can offer those type of products as well, where it's one payment for 20 properties as an example.
All right, so we talked about a little bit buying multiple properties, so always let your LO know right away what you're doing. That way we can kind of navigate and direct you through that process. Different lender versus same lender. I always encourage to stay with the same lender. Keep everything in one house so you can know what your do's and don'ts are and know what your finance options look like. Many borrowers must close conventional refinance on the same day. So if you have several different rehabs working and you want to close them all, you then have to make sure they close on the same day to get credit for the actual lease amounts for each property. So that's very key. You may qualify to close individually. So once again, if you have the W-2 income to cover these new liabilities you're taking on, that works out in your favor. But if you don't, then you have to have the leases in place to offset these new payments you have. And like I said, you may have to wait until the property's leased. So you may have some rehabs you're doing. One could be really big, one could be small. If that small rehab finished first, you may have to wait till the big one is done to close them all at the same time frame.
That's an important point. If you've got 3 properties going, you're going to have to wait until the last one is done if you do not have the ability to cover those payments on your own. So you really want to try and keep the focus on all of your different properties when you're doing 3 at one time or 4 at one time so that you can refinance them as soon as possible. Because hard money is not inexpensive. It's a riskier loan. It's a speculative loan. So you want to be able to get out of that and into the lower rate product. And you're starting to pay down principal, right? That's one of the many beauties, one of the 8 great strengths of real estate is that you're doing principal pay down. You're not doing any principal pay down until you get into your permanent financing loan. Rates, very important in the current environment. You're given the option to lock at any time. Longer locks are going to be more expensive. We typically encourage our borrowers to not lock until they're 15 days out and until you have blue taped your property, right? Because if you pay for a lock and you don't meet it, then you're going to get what's called worst of pricing. That's not a great scenario. You're going to get whatever the worst pricing is. So you want to lock whenever you know your property is complete and you're blue taping it, and we can get that transaction closed in a 15-day period. That's typically what we recommend. Now, you are empowered to lock on a straight refi whenever you choose to, but you're also responsible for it, right? Like, in other words, if we lock on 15 days and all of a sudden there's a positive move in the market, it is what it is. We're not going to be able to eliminate that. You're stuck with that lock. But if you don't lock and rates go up, then you're going to have an increase. So you have to understand that there are risks associated with locks, but we really encourage you to do it at the spot whenever you blue tape so that we can get that loan closed as quickly as possible. Even if it means you might lose an eighth or something like that, we think it's better to play it safe and make sure you can get in and out of that hard money loan more quickly. Choosing to lock or float the rate is entirely the borrower's choice, but we're just going to give you our strong recommendations.
So finalizing your team, so utilize Total Wealth membership to the fullest. So you guys are members of Total Wealth. There's a vendor list. Take advantage of it. Don't have to go out and shop on your own and vet people. They do it for you. Take advantage of the resources you have. Select your partners. So once again, start building your team up. Have a good lender. Have a good GC. Have a good agent. If you're going to buy several properties, you might need a property management team, but build a team around you so you're not doing all the heavy lifting. Always be your partners from a long-term outlook. So how can you help me with this deal, but also future-wise, how do we add value to each other? How do I benefit from using this particular partner? And then be the partners of the desire. So as people are going to talk. So you want to talk about how great you're doing, and also lenders and other people are going to talk about how great of a customer you are as well, and talk and share throughout the community. So be a partner people want to work with pretty much. And then focus on the mutual benefit. How can I help you? How can you help me? We both adding value back and forward is really key.
Yeah, absolutely. Especially with off-market deals, the more desirable of a partner you are because you close on time, you make sure that you evaluate the property before you go out to it. You're not wasting wholesalers or the Total Wealth agent's time. That is a huge part of being first on the list.